All right, let's dive right in. Today, we're going to unpack a really interesting argument that questions something most of us take for granted. Is your paycheck automatically income? We're going to explore the source materials case, which pulls from the tax code, standard accounting rules, and even the Supreme Court.
So let's just cut straight to the core of it. When you get paid for your work, is that money automatically considered taxable income? Now I know what you're thinking. Of course it is. But the argument we're digging into today suggests the answer might not be so black and white.
And this quote right here is the whole ballgame. The argument is that the IRS works on a presumption that your pay is income. But a presumption, well, that's just an assumption until it's proven. It isn't a hard fact. And that little gap between presumption and fact is where this entire argument lives.
So to make this case, the source material doesn't just pull an idea out of thin air. It builds its foundation on what it calls 3 pillars of authority. These are the heavy hitters from law and accounting, and it's all about how they work together. Let's break them down.
Okay, so what you're seeing here is basically a chain of command. According to the source, at the very top you have the Supreme Court. They're the ones who define what income even is. And their key rule, there has to be a gain. No gain, no income. Simple as that. Then you have accounting rules, GAAP, which just tell you when to mark revenue on your books. And way down at the bottom is the tax code, Section 451. Its only job is to figure out when to report income, but only if the Supreme Court's definition of income has been met in the first place.
Okay, now this is my favorite part because the source material was specifically asked to break this down Barney style. And honestly, it's a brilliant way to make these stuffy legal ideas super easy to grasp. We're going to turn them into characters.
So, let's meet the team. We've got a judge, a coach, and a hall monitor. Each one has a very specific job to do, and the order they do it in is everything. You'll see what I mean.
First up, the judge. The judge represents the Supreme Court, the highest authority, and their job is incredibly focused. They ask one single question: was there a gain? They don't care about the cash you received. They care if you actually became wealthier. That's the first and most important test.
Next, we've got the coach, who represents the accounting rules. The coach is just the scorekeeper. When you finish a job, the coach pats you on the back and says, "All right, put some points on the board. Mark it down as revenue." Notice, the coach doesn't say income. They're just recording that you did the work.
And finally, we have the hall monitor. This is our tax code, IRC 451. The hall monitor's job is really simple. They're a scheduler. But here's the key. They don't do anything until the judge gives them the green light. If the judge says there was income, then the hall monitor steps in and asks, okay, which year do we report this in?
And this quote just ties it all together perfectly. If the judge looks at the transaction and says, nope, no gain here, this was just an equal swap of your time and effort for money, then the hall monitor just shrugs. Their job never even starts. The whole point is, the tax code's timing rules don't matter if there's no actual income to time in the first place.
Okay, that analogy is great, but let's see how this plays out in the real world. The source gives us a perfect example of an HVAC repair job. We're going to follow the money, or rather, the accounting. So here's the timeline. November 1st, the work is done. 2 days later, a $4,000 invoice goes out. Now, for accounting purposes, this is the big moment. Your right to get paid is now locked in. But notice, the actual cash doesn't show up until the middle of January, in the next tax year. So, on November 3rd, the bookkeeper makes this entry. An asset called accounts receivable is created for $4,000, and the service revenue is officially recognized. So even with zero cash in hand, the value of your work is already on the books. This is the moment that matters for accounting. Now watch what happens when the money actually comes in on January 15th. The cash account goes up by $4,000, and the accounts receivable account goes down by $4,000. See that? It's just a swap. You traded one asset, the promise of being paid, for another asset, cold hard cash.
And that's the real kicker. According to this model, getting paid in January didn't create any new income. It was just settling a debt. The value was already there. You simply converted a receivable into cash. The question of whether there was a gain hidden in that original revenue is what the judge is for, not the receipt of payment.
Okay, this leads to a super important point the source makes. It's a question you're probably asking right now. So who can actually use this approach? Well, there's a huge difference between being a regular employee and running your own show.
So the source basically describes 2 different worlds. If you're a W-2 employee, your employer is legally stuck. They have to follow the standard IRS withholding rules for you.
But if you operate as a separate entity, a sole proprietor, for example, you are in control of your own accounting. You are the one who gets to keep the books, apply the proper accounting standards, and make the determination of whether a gain even happened.
So let's bring it all home. We're going to circle right back to that powerful idea from the very beginning. The difference between a simple presumption and a hard fact. This is the bottom line of the entire argument.
This chart just lays it all out so clearly. The common presumption is that wages are income, but the stated fact based on court rulings is that income requires a gain. The presumption is that the IRS code is the final say, but the stated law is that the Supreme Court's definition is what really matters. And the presumption is that a W-2 form is proof of income, but the argument here is that the real evidence is your own accounting ledger where the actual transaction is recorded.
And so we're left with this final, powerful question that gets to the very heart of the source materials theme. It's a thought that really challenges you to look past the surface of things. What power does a simple assumption really hold? It's definitely something to think about. Thanks for joining me for this explainer.